Your credit score. It's supposed to be a simple grade for how responsible you are with money. But have you ever felt like you replaying a game where the rules are designed to keep you guessing? Well, you're not wrong. Today, we read diving deep into what I call the credit score trap and how the system often rewards people for staying in debt. In the United States, your credit score is like a financial passport. It dictates whether you can get a loan for a house, finance a car, or even rent an apartment. It determines the interest rates you'll pay on everything. A high score means the system trusts you. A low score, you're seen as a risk. So logically, you'd think that if you avoid debt completely, your score would be perfect, right? I mean, what's more responsible than paying for everything with money you actually have? Unfortunately, that's not how it works. In a strange twist, having no credit history at all can actually hurt your score just as much as having a bad one. Let's imagine two people. We'll call them Alex and Ben. Alex is super careful with money, pays for everything in cash or with a debit card, has no credit cards, and no loans. Alex has zero debt. Now there's Ben. Ben uses credit cards for daily purchases, carries a small balance from month to month, and always makes at least the minimum payment on time. Who do you think has the higher credit score? In most cases, it's Ben. And this is where the trap begins to reveal itself. Credit scores don't measure how wealthy you are or how much money you have in the bank. They measure one thing and one thing only: how you manage borrowed money. The credit bureaus, the companies that calculate your score, are looking for specific data points. They want to see your payment history, how much of your available credit you're using, the different types of credit you have, and how long you've had your accounts open. If you're like Alex and never borrow money, the system has nothing to measure. It's like trying to grade a student who never turns in any homework. From the lender's perspective, you're a complete unknown. They have no idea if you'd be reliable or if you default on the first payment. This creates a bizarre incentive. Many people feel pressured to get into debt just to build a credit history. They'll open multiple credit cards they don't need, carry balances they could easily pay off, and end up paying interest to the banks. They're not doing this because they need the money. They're doing it because they believe it's the only way to get a good score. It's a game where you have to borrow money to prove you're good at borrowing money. But here's the good news. You don't have to fall completely into this trap. You can play the game smarter without letting debt control your life. The key is to use credit strategically. You can open a credit card, use it for small, regular purchases like gas or groceries, and then, this is the most important part, pay the balance in full every single month. This way, you're building a positive payment history and showing you can manage credit responsibly, but you're not paying a single cent in interest. It's also crucial to keep your credit utilization low. That's the percentage of your available credit that you're using. A good rule of thumb is to keep it below 30%, but lower is always better. The bottom line is this: your credit score is not a reflection of your worth or your wealth. It's simply a tool that lenders use to assess risk. Once you understand that you're not trying to prove you're rich, but that you're a reliable borrower, the whole system starts to make a lot more sense. You can build a great score without getting caught in a cycle of unnecessary debt. Thanks so much for watching. If you found this helpful, hit that like button and subscribe for more content that helps you navigate your financial world. See you next time.